If you've spent any time trying to invest seriously, you've run into this question. You're looking at two investments that seem nearly identical, same index, same broad asset class, very similar expense ratios. And one is called an ETF and the other is called a mutual fund. And you have to make a choice. Some people tell you ETFs are always better. Some people tell you it doesn't matter. Some people tell you mutual funds are more investor-friendly. And most people end up picking one somewhat arbitrarily and hoping for the best. Here's the thing. The difference between ETFs and mutual funds is real, but it's not where most people think it is. Understanding where it actually lies will help you make a genuinely better decision for your specific situation. My name is Eddie and I spend way too much time thinking about investment vehicles, tax efficiency, and the structural details that actually affect long-run returns in ways that aren't obvious at first glance. If you want to understand what actually separates ETFs from mutual funds, and in which situations each comes out ahead, hit subscribe and give this a thumbs up if it ends up clearing things up. If you've been confused about which to use and just want a clear, honest comparison, hit that like button. Let me start with the basics. A mutual fund is a pooled investment vehicle where many investors combine their money and a professional manager, or an index tracking algorithm, invest it collectively. When you buy shares of a mutual fund, you submit an order during the trading day, but your shares are priced and executed at the net asset value, or NAV, calculated at the end of the trading day. You buy at the closing price regardless of what happened during the day. There's no intraday pricing. An ETF, or exchange-traded fund, holds essentially the same type of assets as a mutual fund, stocks, bonds, or other securities, but it's structured differently. ETFs trade on stock exchanges exactly like individual company shares. You can buy or sell an ETF at any point during the trading day at the current market price. The price fluctuates throughout the day based on supply and demand, just like any stock. If you want to buy at 10:15 a.m. at whatever the market price is at that moment, you can. Now, for most long-term buy-and-hold investors, the intraday trading flexibility of ETFs is completely irrelevant. You're not buying an S&P 500 index fund at 10:15 a.m. versus 3:45 p.m. trying to catch a price movement. You're investing for 30 years. Whether you execute at the morning price or the afternoon NAV is essentially noise. The intraday trading feature is real but mostly matters for active traders, not long-term investors. The difference that actually matters for most individual investors is tax efficiency, and this is genuinely structural, not just a matter of one manager being smarter than another. Here's how mutual fund taxation works. When you hold a mutual fund in a taxable account, you are subject to capital gains distributions. When the fund manager sells securities within the fund that have appreciated in value, whether because they're rebalancing, responding to redemptions, or actively managing the portfolio, the realized gains are distributed to all shareholders as taxable events. This means you can receive a taxable capital gains distribution at the end of the year even if you never sold a single share of the fund yourself. Even if you've been losing money overall, you might owe capital gains taxes because of what the fund manager did inside the fund. If this is clicking into place, hit the subscribe button and the like button. I'll keep going. ETFs handle this structural problem through a mechanism called in-kind redemptions. When large institutional investors redeem ETF shares, they receive a basket of the underlying securities rather than cash. This means the ETF doesn't need to sell securities to raise cash for redemptions, which dramatically reduces the taxable events inside the fund. As a result, ETFs typically have very low or zero capital gains distributions in any given year, even in actively traded versions. This difference in tax treatment can have a meaningful impact on after-tax returns over time for investors holding in taxable accounts. Vanguard has published analysis showing that the tax drag from capital gains distributions in actively managed mutual funds can cost investors 1 to 2% of annual return in taxable accounts. For index funds this is less dramatic, but even passive mutual funds occasionally generate capital gains distributions that ETF equivalents typically avoid. Now, ETFs do have one tax disadvantage compared to mutual funds in certain situations. When you sell an ETF, you might owe taxes on any gain in the ETF's price. This is not different from selling a mutual fund at a gain. Both are taxable. The key distinction is that mutual funds can passively push taxable gains onto you even without a sale, while ETFs generally don't. What about expense ratios? The honest answer is that this depends entirely on which specific fund you're comparing, not on the ETF versus mutual fund structure itself. The Vanguard S&P 500 ETF charges 0.03%. The Vanguard 500 Index Fund, mutual fund version, also charges 0.04%, nearly identical. Fidelity's Total Market Mutual Fund charges 0.015%. There is no reliable rule that ETFs are cheaper than mutual funds across the board. You need to compare specific options. There are a couple of practical advantages to mutual funds worth mentioning. First, many mutual funds allow fractional share investing without a minimum per transaction. You can invest exactly $127.43 in a mutual fund and it will buy $127.43 worth of shares. With ETFs, you traditionally had to buy whole shares, though many brokerages now offer fractional ETF share purchasing. Second, many mutual funds allow automatic investment with dollar cost averaging set to specific dollar amounts rather than share counts, which is convenient for automated monthly investing. The bottom line is this: for investors using taxable accounts, ETFs generally have a meaningful structural tax advantage that compounds over time and tips the scale in their favor. For investors using tax-advantaged accounts like IRAs and 401ks, the tax efficiency advantage of ETFs is irrelevant because capital gains inside these accounts aren't taxed annually anyway. In tax-advantaged accounts, the choice comes down to expense ratio, available options, and your preference for automatic investing features. For most people, the honest answer is, in taxable accounts, lean toward ETFs. In tax-advantaged accounts, use whichever option has the lowest expense ratio and works best with your investment workflow. The structural difference is real, but it's primarily about taxation, and if you're not in a taxable account, it matters considerably less. If this finally cleared up a question you've been sitting on, share it with someone who's been confused about this too. Subscribe if you're not already here and hit that like button on the way out. See you in the next one.